This past March, Matt Smith did a video valuing Lemonade at $80 a share. We are financial advisors. This is not financial advice. At the time, Lemonade stock was trading at $16 a share. Now it's at $50 a share. A little bit has changed, not a ton, a little bit. Lemonade just had their investor day, and it's caused us to look at a different bull case on our valuation. Our base case back then was $82 a share. The stock has filled up the gap. Lemonade is now cash flow positive, but they outlined a vision for how their company is going to go from 1 billion in in-force premium, so that's premium that they collect from their customers every year, to 10 billion annually in perhaps 8 or 9 years. They guided toward a 30% growth. Matt, anything to add? And then let's get right into our new valuation. This is our super secret bull valuation.
Yeah, so the secret's about to get let out. I think you set it up well. Let's walk through the model and give you a look at what some of these out years look like. This is, as far as our model goes out right now, it goes out to Q1 of 2033. The way the math works with this, by this point, the company wouldn't quite be at that $10 billion mark in in-force premium, but they would essentially get there later on in 2033. So this just gives you an indication of what it might look like right around the time. So I know 2033 sounds like a really long time away, and it is. Not to say this model is right, but just to give you an idea of what makes us so excited about this company in the long term. Why do we think the economics are just not well understood? When you start with this roughly 10 billion, let's call it 9 billion of in-force premium, you have gross earned premium of roughly 1/4 of that. So how much in any given quarter are you recognizing? Now they're going to cede a good chunk of that to reinsurers. We have assumed that once they become cash flow positive, they'll be ceding less of their premium, gross earned premium, to reinsurers, and they'll be having more of it on their balance sheet, underwriting it themselves. So there'll be some mix. This isn't really a core assumption. This could change one way or another, but even if it stays flat, results don't change drastically. Although you do have to pay reinsurers a little bit more to take on that risk. Essentially, you get to a point where they're doing 1.8 billion in revenue between all these different sources per quarter. And the interesting thing is, because they're so cash flow positive, you can just see how their net investment income really grows over time. Your earned premiums are growing just as you grow that in-force premium. But the way the working capital works with an insurance business is you collect the premiums up front and then you pay out claims if and when they happen. So this is one of the things that made Warren Buffett so much money, is that concept of float, where you are able to earn a return on the cash that your customers are prepaying. That's a very nice dynamic, especially when an insurance company like this is growing as fast as Lemonade plans to.
How dare you talk about float when they're not profitable today?
You know, they're cash flow positive, so float actually matters today, even though they are GAAP net income negative. I know this is really complicated for people who love to do shallow financial analysis out there to really grasp, but you don't tend to not go bankrupt if you're GAAP net income negative, as long as your cash flow is positive. So something to keep in mind.
Matt, could you zoom in and go down and to the left over to where Lemonade is today with their earnings, and show us a little bit of the earnings progress that we expect over the next few years?
Sure. So I'll just jump down. You can see earnings per share minus 60-ish cents right now.
Is this trailing or quarterly?
This is quarterly. So, you know, roughly $3-ish a year, something like that. Is that what this equates to? Yeah, a little over 3. A big piece of this, which we've spoken about in other videos, is that the company is reinvesting a lot of their cash into acquiring new customers. That hits their income statement in the quarter in which the expense is incurred, even though this customer is going to have a lifetime value that may be 5, 6, 7, 8 years into the future. So this is why I think you've got this dynamic of, in the short term, the company's financials look a bit like a hot mess, at least if you're looking at the income statement. But then you're going to have this benefit paid to acquire all these customers in year 2030, 2031. You start stacking on all these very profitable customers who are satisfied and want to stay with you. At that point, the financials just become extremely impressive.
People who are short are just pretending that Lemonade spent this money and they're going to get no benefit from it.
Yeah. Meanwhile, they shared a spreadsheet talking about triple-digit IRRs, which is insane. But, you know, Shai Wininger, their CEO, tweeted that out on last Tuesday during the investor day. And it's like the math is actually pretty straightforward. I know a lot of people don't want to do the work to put together a big spreadsheet like this. Just to give you an idea of the amount of work that goes into it, the amount of work you have to do to look at all the different cohorts and how their economics adjust over time. Like there's a fair amount of work, but like you have to look at each year, how many customers am I adding? How many of them churn off? What's the bundling amount that they do and add them all together? But then like you can see is you add this cohort, then this cohort, then this cohort, that the economics really improve significantly over time. It is a fair amount of work to understand it, but it's well worth doing.
So when Matt says cohort, he means group of customers that you're adding each quarter. You look at the spend that goes out the door to acquire that customer, and then you're tracking the cash flows that Lemonade gets after acquiring them as a customer, given assumptions about the profitability of those customers and how long they stay with you. Matt, maybe you could zoom over and show us when we have them turning EPS positive, and show us what
here
the earnings looks like. So that's what year?
So this is June of 2027, Q2 of 2027, which aligns with what management said they'd get adjusted EBITDA positive in 2026 and GAAP net income positive in 2027. We're not sure exactly what their model looks like, but this does seem to at least kind of track. You can see here, going from losing 50 cents-ish a share for a long while, and I could definitely imagine a scenario where the bear case is alive and well all through these years, even as we're seeing the progress on the fundamentals. Then what happens is you switch to profitable, and then you keep adding to like more and more and more profitable because you are continuing to add these really profitable customers. And then the 2030s hit, and all of a sudden you're at $1 in earnings per share per quarter. And you don't stop there either. So by the end of this model, Q1 of 2033, you get to a point where your trailing earnings per share, this is adjusted earnings per share, so adding back stock-based comp, is over $8. It would have been growing at 37% year over year. One of the things we were thinking is, all right, let's just say you've got a 40 multiple on that with that level of growth rate. And
that's a PEG of 1. That's really good growth. Yeah. So you would get a PE to growth of 1 with your multiple.
Yeah, so that implies a future value in 2033 of $323 per share. And this is a stock that's trading at $50 right now. So this is why we think the company could be such a strong grower in the very long run, like a company that, frankly, you wouldn't mind just buying, holding, and kind of forgetting about as long as you're comfortable with the long-term vision and seeing where they're going. On a present value basis, this is roughly $130 per share today. But what's interesting is if you're building a model like this, it all should kind of sing together. So when we went and actually looked at what the discounted cash flow showed, is the same thing, $132 per share. So this gives us a fair amount of confidence that there is going to be significant upside for Lemonade. Now, a couple quick caveats. If the stock was trading at $132 today, I don't think this would still be a good sell. The reason is you would only expect to grow at the cost of capital going forward. There's a fair amount of execution risk in order to achieve the type of numbers that we're looking at in the 2030s. While we do think, this company is eventually going to be doing hundreds of millions of dollars of cash flow and net income per quarter, there is some execution risk to bridge the gap from where they are today to this future that looks very reasonable to us, but it's not a slam dunk that this definitely will happen. So I think there's some sort of discount that you'd want to apply for just execution risk along the way.
So there you have it, our super secret bull case for Lemonade. 133 a share present value today. That's not a 1-year price target. We don't think that Wall Street or retail investors are going to agree and suddenly move the stock from 50 to 133 a share. And excited to share this with you. This doesn't include other potential upside scenarios, like other ways that Lemonade can get people in the door, other types of insurance, and expansion of life or home policies. Mainly, this is what Lemonade was showing us at Investor Day. I think actually does include some home increase to like 1 or 2 billion, right?
Which they included in their model, but they're not leaning heavy into that. Even if you say the stocks will triple from here, that's the $10 billion market cap roughly, and that's still relatively small when you look at the market cap of other insurers out there. So there is this crazy idea that the company could 10x from where they were. Let's call it at Investor Day, it was roughly $30 per share, 10x to 300. You could 10x again to 3,000, at some point in the 2040s and beyond. And that's the point where you get to the big leagues of the larger insurers out there. It's such an attractive market. They've got so many advantages. It's really exciting stuff they've got going on.
So we're going to be adding some more videos about Lemonade. Sorry about that if you only want to hear about Tesla, but this is pretty exciting. There's a 30% short interest. Jim Chanos seems to be short Lemonade. He's bashing Lemonade. And Lemonade is just a tech company masquerading as an insurance company. Look out for those videos. I'm going to put one here, maybe there. Matt, you could do the same. Go ahead and do that. And we'll put them there.
Videos everywhere.
Check them out. And with that, I'll say bye for now.
Bye for now.